In this last set of ratios that we'll look at, we will compare Ashley's attic with Kadens' closet on a series of ratios related to their share price. So specifically, we'll consider both firms' price to earnings ratio, their dividend yield percentage, their free cash flow, and the quality of income ratio. As we're putting these ratios together, 3 questions for you to think about. 1, if the total returns expectation of the stock of both companies are the same, which firm is expected to have more stock price appreciation in the future? 2, which company is generating more cash that they could direct towards new initiatives? And 3, based on these metrics, which company could be at higher risk of future performance disappointments? In other words, which company is at greater risk of underperforming their future expectations? So these are the ratios that we'll look at. So again, keep these discussion questions in mind as we walk through these questions and these ratios. And now we'll transition to the spreadsheet. Okay, so we'll shade the previous work that we did here. So let's give it maybe a gray color because it's related to the previous. Now we'll look at some new ratios. Price to earnings ratio. So for Ashley's attic, this is going to be the market price per common share divided by EPS. So let's look at the market price per common share. Let's see, stock price per share at end of the current year. So we've looked that up in advance. And let's look at the price to earnings ratio relative to EPS, which we calculated. So the PE ratio for Ashley's attic looks like it's 15.49 or so. So now let's make a similar calculation for Kadens' closet. So stock price is also $19 divided by EPS. So let's look at their EPS here. So it looks like the PE ratio for Kadens' closet is about 13.52. Let's look at the dividend yield percentage for each. This is going to be the annual dividend per share divided by the market price per share. So let's take a look at Ashley's attic. Let's take a look at their dividends per share. So we're going to have to do some intermediate calculations. We'll have to take dividends divided by shares outstanding to get dividends per share. And then, so that's this first number. Then we will divide this by the market price per share. So the dividend yield percentage looks like is about 3.45% for Ashley's attic. And let's repeat this calculation for Kadens' closet. So it's going to be dividends divided by shares outstanding to get a dividends per share measure, and then divided by the stock price at the end of the current year. So it looks like for Kadens' closet, the dividend yield is closer to 4%. So Kadens' closet has a higher dividend yield. Now let's compute free cash flows. Free cash flows are cash flows from operations minus cash payments for PP&E, i.e. capital expenditures. So let's take cash flows from operations for Ashley's attic. So we have cash flows from operations minus cash payments for PP&E. So this is $49.85. And so for Kadens' closet, we can repeat this calculation. Cash flows minus cash payments for PP&E. So this is $33,598. And then we can also measure quality of income. This is a ratio that takes cash flows from operations divided by net income. So the cash flows from operations divided by net income for Ashley's attic. This is going to be a ratio of 1.55. And then for Kadens' closet, this is going to be a ratio of 1.345. So it looks like Ashley's attic maybe has higher quality of income. So let's return to our slides. So these are the outcomes of what we just looked at, right? So we calculated them in the spreadsheet, but now we can take a look at this and we can think about our discussion questions. So if the total return expectations of the stock are the same, which company is expected to have more stock price appreciation? So here, one way to think about this is which firm has the higher PE ratio. So in this case, Ashley's Attic has a higher PE ratio and Kadens Closet has a lower PE ratio. But if we're expecting both firms to deliver the same returns, then in theory, we should be waiting for Kadens Closet stock price to match Ashley's. So we might expect Kadens Closet to have higher stock price appreciation in the future, assuming the two firms generate the same returns. And that's a big assumption. So it would depend on what your expectations are. The next thing we can think about is which company is generating more cash that could be directed towards new initiatives. That would be Ashley's Attic. They have more free cash flow than Kadens Closet. And finally, based on these metrics, which company could be at higher risk of future performance disappointments? So it looks like Ashley's Attic has a higher price to earnings ratio. So what that means is that investors are anticipating greater growth in Ashley's Attic future earnings because they're willing to pay more for the same earnings today. So they're expecting more growth than they're expecting from Kadens Closet. So this sets up higher expectations for Ashley's Attic. So if Ashley's Attic can't deliver on these heightened expectations, then investors could be more likely to be disappointed in the future. So that wraps up our comprehensive example of financial statement analysis, where we can use financial statement ratios to analyze and compare the investment potential of two different firms. In this exercise, we compared two hypothetical firms, Ashley's Attic and Kadens Closet, both of whom were clothing retailers, and we conducted a series of ratio analyses to help us analyze and understand the financial performance of each firm, as well as the suitability of each as an investment. So hopefully this video was useful to you in walking through many of the financial statement analysis concepts, and I look forward to seeing you on a future video.